So, a coworker just gave you a hot stock tip. And they sound pretty convincing. What should your next step be? The short answer: do your research. As insightful as your coworker may seem, it's crucial to perform your own due diligence on any investment before risking your hard-earned cash. Due diligence, or DD, means digging into the details, making sure you get how a company runs, so you can figure out if it's worth investing in. There are many parts to due diligence. One of them is fundamental analysis, which looks at how capable a company is at generating profit. At its essence, this involves examining financial statements and reviewing trends and data to get the full picture. That kind of research helps you judge whether a stock is fairly priced, underpriced, or overhyped by the market. Fundamental analysis is a wide field, but you don't need to do everything alone. You can choose how much research to take on yourself and what to leave to the experts. Due diligence has multiple components, but in this video, we're focusing on 4 key ones: earnings, capital structure, management, and expectations. To begin, you need to know where to access reliable data. Publicly traded companies are obligated by the SEC, the Securities and Exchange Commission, to make financial data public through quarterly 10-Qs and annual 10-Ks. Despite how it sounds, it's not a speed contest. These documents are packed with pages of dense financial details that can feel like a marathon to read. Thankfully, there are tools that make it easier, if you know where to start. Some of the most essential numbers for any company are found in the income statement. That's where you can see how much revenue remains after the company pays for its expenses, like employee salaries and utility bills. This leftover amount is called net income, also referred to as profit or earnings. And it's vital for understanding a company's value. Why? Because the stock market is basically a marketplace for buying and selling a company's future earnings. As a general rule, earnings and revenue should grow quarter after quarter and year after year. But that's just the beginning. You can also look at how fast earnings are growing, or assess how good a company is at turning a profit. This means crunching a lot of numbers. It involves using data from financial statements to calculate financial ratios. These ratios act as standard measurements that help you assess a company's past performance and give clues about its future. Luckily, much of this work is already done for you. You can access many tools and ratios for free from most brokerages. Just check out the research section on sites like Schwab.com. For instance, net profit margin is one such ratio. It compares total revenue, or sales, to the net income that remain after expenses. Net profit margin is given as a percentage. A company with higher margins usually has good expense control and may be efficient at generating profits. Profit margins, like other ratios, are useful for seeing how a company is growing over time, or how it stacks up against competitors. Many investors identify top companies by comparing ratios within a specific industry group. You can also use the price-to-earnings ratio, PE, to figure out how much you're paying for a company's earnings, and whether the stock seems over or undervalued. It's a simple comparison: the price of a single share divided by earnings per share. So if a stock trades at $20 and earns $1 per share, its P/E ratio would be 20. Some investors lean toward companies with lower P/ES, believing they offer better value. Now, while there are other ways to evaluate earnings and revenue, another crucial area of due diligence is capital structure. That's all about how a business gets funded. A company can raise money by issuing stock, equity, or by borrowing, debt, through loans, bonds, or mortgages. When a company takes on debt to expand or develop new products, it can impact future profits. Debt must eventually be paid back, so it essentially lays claim to future earnings. Companies with strong capital structures typically keep debt manageable, while growing equity through retained earnings they reinvest. A key tool for this is the debt-to-equity ratio. It shows how much debt a company carries relative to its equity. A high ratio, especially one higher than industry peers, might indicate the company is too heavily in debt, which could harm future profitability. Still, debt norms vary by industry, so comparing companies within the same sector is essential. We've talked numbers, but what about the people behind them? Management effectiveness analysis measures how well the company's leadership team runs things, and it's one of the few soft metrics that's still extremely valuable in evaluating investments. While good management may seem hard to measure, there's actually a ratio for that too: return on equity, or ROE. The higher the ROE, the better. It's calculated by dividing net income by average shareholder equity. If a company scores higher than its competitors, investors might assume its leadership is good at making money. Still, it's not just about math. You can read what the company's leadership is thinking by checking out their investor relations page, their 10Ks and 10Qs, or by reading analyst reports. These sources reveal what management is focusing on, like product launches, growth targets, or potential dividends. Companies are also required to share any current risks, which is crucial to factor in before investing. Risks might involve lawsuits, or challenges like struggling to attract customers in key markets. That's a great reminder of why it's smart to diversify your investments. Spreading your money across different industries. That